chance to give people a chance to get in the room, get their coffee, get settled down, and then we'll get started.
Good, good, good.
Okay.
You don't want to talk about anything particular right now about oil prices or
Yeah. Tell me
alternative?
about. I did check the West Texas Intermediate crude price this morning,
Yeah,
knowing I was going to get on with you guys. So, uh, and you were saying you were on Houston radio station. I lived in Houston for 20 years, and I always remember every news report, including the WTI. Uh, it's like pork belly futures in Kansas City or St. Louis. Yeah.
exactly. Yeah, or
Yeah.
Midland,
Yeah, Midland.
or Midland. First
Yeah.
page on the newspaper in Midland. Oil price.
Oh, oil price.
What's oil price? It affects. Well, it's because it affects so many people, especially in Houston or Midland or Odessa or these small towns that
It,
my grandfather, great grandfather, my grandfather grew up in these,
wow.
small towns around Texas. And man, when oil went out, the whole economy went. That's where ghost towns, originated. The gold rush or oil and gas or something like that. It's
Interesting.
amazing,
Yeah,
because it's for
even
the
when I'd
economy.
gone down there, and I went down in 1980, and it was just at the tail end of a big boom, and the mid 80s were a pretty sad time.
Yeah,
As I bounced between Dallas and Houston, and that stretch of road was growing and developing, and then it sort of withered away. A lot of stuff on there, but
yeah.
yeah, when it goes, it goes. So it's kind of
That's when I
funny.
went to college. I went to college at early '80s, and my dad was like, "You don't want to get in this oil business. Prices were crazy, and
Right.
everybody's getting out of it." And that's when computers were becoming
Right.
something back then. But yeah,
But
oil was down.
still one of the biggest businesses in the world. So, and it's not going away. So,
Yeah.
we're here to talk about how to add something in oil and gas into your portfolios, just as you'd add any other asset class. Uh, we've got Jay Young and Tom Gray from King Operating Corporation to come in today and talk to us about what they're doing and how investors are working with them. And Jay is the founder of King Operating, and the company's going to have its 30th birthday next year. So they've been around for a bit. And he's the author of The Upside of Oil and Gas Investing, and he is the developer of the Acquire, Develop, and Divest Strategy of Investment. So we're going to touch a little bit on that today.
Hmm.
Tom Gray's been with Jay Young for 20 years. He's been in the oil and gas business for 25 years, and he's going to add his perspective. So you got combined experience here, for, headed towards a century. So got just one housekeeping item. I'm Joe Fulvio with Camaplan, and welcome to another edition of the Camaplan weekly webinar. First, the lawyers have to have their say, and this is the heretofores and the notwithstandings. We don't provide any advice. We're a neutral third party. We're prohibited from providing any advice. We're not an investment advisor, a CPA, or a lawyer. I didn't stay at the Motel 6 last week or any of that stuff. And so anything on here is offered strictly as educational. And we say this, I could probably repeat this in my sleep. My wife would probably tell me that, is whenever you do anything, talk to your advisors, talk to your tax person, your CPA, if your lawyer, if you need to, but
Hmm.
don't fly solo. So with that, I'm going to drop off here. I'm going to stop my sharing, and I'm going to invite Jay and Tom to share their screen. They've got some slides to present.
Awesome. That's going to take a little bit. That's going to take a little bit
Take
of.
your time. Yeah,
Yeah, I'm
we're
going to get
good.
there. Or there is the deck.
The people watching this right now are just have a sip of coffee and
There you go.
maybe check the price of Texas Intermediate crude. And certainly they'll be
All right.
checking the Dow. All
Let me
right,
make sure.
I think we're getting
Is
there.
that it? Is that it yet?
Says you are screen sharing. I see.
Okay. Maybe that's not it. Maybe there's another one.
Yeah, I'm off it.
I
So
do have the deck. There's the deck here. Okay.
sometimes
And now,
you
well, I think I hit the wrong button when I hit
all right.
the screen share.
You hit screen share and select your screen, and sometimes it makes you say this one, go ahead and do it. And I always
Or
use that.
screen. Yeah. Yeah, that's not what I normally see. Start broadcast. That's what I had last time. Photo share camera.
And
Mm-hmm. Share here.
the little green button,
Screen. Yeah, we hit that.
the little green button,
It's a screen broadcast, and it says,
and you should have pictures of your, of your presentation. Should it be
see what happens right here.
when you share?
Oh, we're being recorded now. We don't want to be recorded. Okay, I'm sorry.
That's all right. We can slice some of this out on the.
Or do you have it? Were you sent this deck?
Yes, I
Was
was.
he sent the deck?
I can pull it up on my end.
Whoever else can do it. I just, for some reason, bookmark, whiteboard, website. It's just not showing. When you say screen, it's just not doing it. If anybody else can do it, that would be great and
Okay.
appreciated. We're going to talk about alternative energy, and we're going to talk about a lot of the reason why prices are. It's a good time to buy. It's a good time to drill wells right now in the United States, and the reason why is because you buy low, sell high, and when prices are at 60, I feel like they're going to go from 60 to 80. That's kind of the turn here. And when you go from $60 a barrel, 50 to $60 a barrel or more, that's when you want to drill. And
Can you see that?
Yeah, we see that.
Okay.
Good, appreciate it. But we're going to go into that. We're going to go into a lot of great information here, and I'm a fourth generation oil and gas guy, as Joe mentioned, and my great grandfather's in the oil patch. My grandfather was in the oil patch, and I grew up with my grandfather back basically on weekends driving his three speed on the column, the good old 3-speed on the column pickup truck in the oil fields as he was going through. And he would tell me when we were driving by an oil well, he would say, okay, go real slow. And he'd roll his window down manually, and he would listen to the pumping unit to see what's going on with that well. And he could tell if rods were in the tubing, or if there was a downhole pump or anything mechanical on top of the well. So there's a tremendous amount of, this is not an easy business, but we found a way for clients to make money. And I wrote the book Upside of Oil and Gas Investing because I wanted people to know there is a different way and there's a better way to invest in oil and gas. So thank you very much. Tom, you want to start going through these slides? And this is about the disclosure information. We have the same disclosure as you guys do. I'm not going to go into different assets of exactly what we do. This is not what this is for. This is purely informational, and it's about the reason why I wrote the book. Forbes was my publisher. It's been a #1 bestseller, and we're going to talk about that, but there's always risk involved, and I will go over the risk as well. So why King? We have 200 years of combined experience. Joe mentioned we're founded in 1996. I worked for another company from 1990 to 95. I started a marketing company in 95 and started King Operating in 96. So we're still going strong. We look to create value for our investors by offering opportunities for tax advantages, monthly passive income, and a potential multiple on invested capital. So our big, what I love is twofold. Yes, I love to create cash flow for investors, but number two, that's how we get paid. We don't take operator fees on money that is not being generated. I don't like it when people do it 2 and 20, because then they go, hey, yeah, well, I get 2% management fees, whether I make money or not. We don't take that. We take a piece of the production. So if you're making money, we're making money. Next slide is energy consumption. Why oil and gas right now? Energy consumption. A good friend of mine, John Malden, this is one of his favorite slides. He talks about the energy consumption. Oil and gas goes up and down because of supply and demand, and demand's not going away anytime soon for oil. We talk about that. Matter of fact, I talked about it this morning. I'll talk about it tomorrow on another radio program about, what's the peak oil demand, meaning where's the peak and when does it start going down? We don't feel like it's for another 5 years, 10 years. So oil is around to stay for 5, 10, 15 years, because oil demand, the demand for oil, because people like to, it was like George Bush said in one of his State of the Union addresses, we have an addiction to oil because we like to drive. We like to put on makeup. We like to have plastics. We like for roads to be nice. I mean, there's all these different uses for oil. It's not going to go away anytime soon. Yes, we'll see fluctuations in oil prices, but, don't freak out just because oil prices go down a little bit. It's not the end of the world. The forecast, which is what we talked about a minute ago. Yeah, forecast for oil is going to keep going up, and you'll see electric cars, or you'll see people using alternatives to oil, but it'll take years and years. Next is expectations. OPEC expects world oil demand to increase 10.6 million barrels a day by 2028, and just continuing to rise. So that's what it's all about. It's all about demand. Demand stays strong, then you're going to have cycles. So we'll see cycles going in, and matter of fact, we may talk about this at the end of the program when we talk about more about oil and gas and more about cycles and OPEC, and why does OPEC or Saudi Arabia put oil on the markets or take it off or whatever the case may be. And they do that because they're playing the long-term game, and they want to see prices continuing to, fluctuate, but it's all about demand, and it's all about, the supply. And if you, like when OPEC, oversupplied our markets with oil right before the pandemic, they put a tremendous amount of oil on our markets right before the pandemic. And then our demand went way down. I mean, went almost out. Well, people stopped drilling. And I believe it's the next slide, Tom, you showed me yesterday. Yeah. Look at this. This is one of the most amazing graphs that you'll ever see when you talk about oil production. And this is why I love our business model, because we don't stop drilling inside the fund. And how do you achieve that? But you see the first it goes up, millions of barrels a day. And all of a sudden you see where it goes down. I don't know if there's a clicker, Tom, that you have, but you can look at the production from existing wells. You see what happens? That's if you quit drilling. You quit drilling, production from existing wells just goes down. What does that mean? Well, you have to continue drilling for oil and gas. If you don't, you're dead. So therefore you have to continue to drill. This is why this is an exact replica of why I created the model for oil and gas and investing in oil and gas. That's why I wrote a book. That's why I've been on every news source there is. And I don't like to brag. I just don't want clients to lose money in oil and gas. And it drives me crazy when you see that there's a better way to invest in oil and gas, and you see facts, but oil and gas sponsors don't see this fact right here, that, if you invest, you're not going to get your money back because the production goes straight down. Okay. I hope we have a lot of questions too, but, Joe, you got anything?
Well, you mentioned earlier that when when oil hits $60 a barrel, that that's a good sign. And you know, we hear a lot from the people in traditional securities. They talk about technical factors like a floor underneath of a new price level. Our gold and precious metals guys have been talking a lot lately about what's happening with their commodity. Does that perform? Does it establish a floor? Everyone gets comfortable with that, or is it strictly demand driven? As you know, gold is a little bit different.
Yeah. Well, yeah, it's good question. And I think it's more, about if you see rig count, which rigs is the amount of oil that's out there drilling for oil and gas. And if you see rig count go down 5-10%, which you will here pretty soon, no question. I mean, companies may keep 10 rigs running, but not 20 in these times when oil prices are going down. They'll keep going because you got to drill through it, but you see prices, they may not have as many dollars at risk. But like I said, now is a good time for an oil and gas company like ours to come in and start drilling at cheaper prices, because you want to buy low, sell high. You don't want to, people, man, they were when oil was over 100 for during Obama and went to 120. People were like, we want to get in this oil business. We want to get in this oil business. And I'm like, man, let's don't get too carried away, because, it's going to go down. It's a cycle. And all of a sudden they're like, oh, why? And I knew people that were, I knew a guy that was a punter in the NFL that was working in the oil patch in Midland, and as a salesman. Why? Because they needed people, and he had zero, experience in something like this, but he needed a job, and they had plenty of jobs out there because they were selling like crazy. But it is cyclical.
I think the Navy was looking at, they were doing forecasts and they were saying, well, their top end forecast was $250 a barrel, and a lot of that drive that was a totally worst case scenario, but it drove the headlines for a while.
Yeah.
And probably a lot of people got into it. And it's that way with every form of investment, that people jump in when everything is on fire,
Right.
And they get to ride it all the way back down again. So.
Right. But and two, people need to realize as well that when oil prices do go down, less people drill. So it costs me a lot less money to drill a well. It may cost 10 million to drill a well up in the well, I can't tell you where, but because but it may cost me 5 million, 5.5 million to drill one up in the Panhandle, where it may cost only 10 million instead of 12 to drill one up in the other place that we have up in the Panhandle, Amarillo. So therefore, you can look online and see where we're drilling, but we concentrate in 3 different areas. But that's because there's a lot less people out there. And during the boom, everybody goes in the oil business and everybody goes in the service business and starts buying pipe and everything else. And then all of a sudden, because they can sell, they get a customer, and they all of a sudden they start a business. And then when there's not as many people drilling in the business, or your majors they already know who they're buying from. But you have people like us that are independent. We get 3 to 4 bids on everything that we have. Well, there's 3 to 4 companies out there, and they'll drop their prices just to keep their doors open, because not as many people are calling. So that's a good thing for us. I mean, I love this time, and I know it's kind of an oxymoron. I don't like it on our production side, but when we have, we're producing 100,000 barrels a month in one of our funds, and would you rather get 70 or 60 or 80 or 100? It's like, I don't like it there, but also too, we're playing the long game as well. And we're looking at it from a standpoint of, hey, you know what? Today is a good time to drill. Nobody's buying right now. Our cash flows are down a little bit, but we also have it to where, we're going to drill wells. And that's what we love doing. That's what I love doing. And I put everybody around me on our technical teams with Tom and everybody else just to drill, because I love to drill for oil and gas. And that's what we build on.
Speaking of playing for the long term, markets hate uncertainty, and there's been a belly full of it the last several months, and it probably will be for the foreseeable future, near-term future, maybe throughout the rest of the year until things hopefully settle down a little bit. How do you guys see this? And I'm talking about everything from inflation's eased off a little bit, but it could come back as a result of tariffing. We don't know. The experts the experts have been wrong about other things, but how do you guys see it?
Yeah. Well, and Tom, if you don't mind, I'll pop in. You're welcome to join us. But you know, I've never heard this uncertainty term before, or as I guess mentioned many times. As you do, the matter of fact, there's an uncertainty index. I never heard that before until it's
There
normally
is.
at 20, but now it's at 42. I think it's come down a little bit. I mean, it is what it is. I mean,
Mm-hmm.
it has no bearing on how I make my investments. Right now, I love oil and gas as an alternative. I love the tax benefits. I love the income. As we scale the investments, we're making another investment into this fund as well, but which I can't talk about. But you're welcome to call us. But you know, but uncertainty, you know, is I think more for the stock market or something that's has a lot more volatility. With us, we don't. We raise X number of dollars for a fund. We go out there and we drill wells inside the fund. I don't know what the next slides are about King, Tom. Yeah, okay. Let's just. This is about energy demand. Is there anything else? What's the next slide?
This is
I don't know if it talks about us at all. Global Center data. Okay, let's just stay right here. But what we do is already have the properties outlined from our geologist engineering standpoint. So we're going to go out there and look at different areas to drill. And there's one certainty, how much oil is going to come out of the ground, right? Because you drill for a well, you know how much oil is going to come out of the ground. What you don't know are the other two factors, and that is how much it's going to cost you to drill that one well. And the second is how much reserves going to come out of the ground. You know that's the oil's there, it's going to come out of the ground. But the third thing is what's the commodity risk. So you want to see it where you buy low. Let's go drill these wells today, and hopefully by the time we put these wells online, the prices are $80 to $90 or whatever. We're experiencing a higher. So, but this is the oil business, and I know people are like the most riskiest investment ever. No, it's not. It could be, and I could make it very risky, but we've mitigated a lot of that risk by going to where oil's already been found. We know before we drill a well, basically what's going to come out of the ground. We give it 90% chance, 50% chance, a 10% chance of hitting a certain amount of oil and gas. So, we drill wells like Exxon or Mewbourne or other big companies that we're not drilling offshore risky investments, because 9 out of 10 times you're going to hit a dry hole, no income, not good. So we're drilling in places where oil's already been found. There's a lot of majors that are also drilling wells in these areas that, like I said, once you drill a well, you know what you're going to get. It matters, because you may drill 5 wells beside each other. You get 5 different production levels, or EURs, we call them, estimated ultimate recovery. You may get 5 different ones, but they're going to be within 10, 20% of that number. You may get, let's say, 500,000 barrels on the mean or the average, and then you may get 400,000 on one, 600,000 on another one. So but pretty much what you're going to do in drilling, and that's why I've developed our model. Assume it taken my whole entire career. Don't tell my wife I said almost took it or whatever, but taken. It's taken my entire career to put this project together, and the model, if you will, on exactly how do you put it together, how do you increase value over time, and how do you divest. So it's and I'm very thankful that I'm here today talking to you and your people.
You've got a proven model. You're drilling in areas that are not speculative. If you could go back, Tom, to the last slide, which talked about demand in different areas, this is what really kind of drives home the point, is that in the short term, there might be a lot of bumpiness, but really, I talk to people in the electric power generation, transmission, and delivery business, and Pico up here. I think it's Exelon down there, and they're aghast at what they need to build to meet the demand that this is going to bring about, AI and data centers alone. So when you look at that demand chart that you showed earlier, which there, that's not going to slack off. That's a given.
Yeah.
That whatever short-term turbulence occurs, that in the long term, the demand is there for the product. So, and we see this in whatever happens to the price of building materials and single-family homes, we're looking at a 5 to 7 year backlog of demand for single-family homes. So whatever happens in the short term is not going to make that demand go away. So, if you're looking at this from an investment standpoint, this slide here kind of drives it home that there's just an appetite for this, and you guys are able to get it out of the ground in places that are already producing, and you've got a model for rewarding investors for it. So that's pretty interesting.
Definitely. And you look at the big one, the bottom one, data centers. Tom, talk about that data centers a little bit.
Yeah, this slide here, this slide again comes from John Malden, who's our chief economist, very good friend of Jay's for over 25 years. What you're seeing here is energy use per decade per billion. And you can see what cars, aircraft, chip factories, which are very much on the rise. But the big one, like Joe was just saying, is data centers. These are AI centers. These are Bitcoin mining centers. Just in the next 2 to 3 years, you're going to see demand in this area go up exponentially. You're going to need a lot of oil and a lot of natural gas, and the way our funds are set up, they're about 60% oil, 40% natural gas, and you can see here. I mean, look at the difference between data centers and vehicles, or combine all three of those top ones, and then look at the bottom one. That's pretty amazing what's going to happen.
Yeah, they're talking about it in terms of the new industrial revolution with what's going to happen with this. It's really astonishing. So, and then you've got logistics, you've got reshoring that's going on here. The capacity for demand is pretty stiff and stout. So, let's talk a little bit about the investment. Now, we've got IRA people listening in here, and I think there was a slide or something on your website which showed the different characteristics of the investment, and you can start here and start walking us through that, so I don't step on your toes on this, but go ahead and walk through the investment.
Okay. Well, this is why King, and we've talked about it a little bit. And oil and gas is 100% write-off, but that doesn't have anything to do with your IRA. We feel like it's an incredible partnership as well with cash flow, because I sit and think about how can I create the best fund investment vehicle for an investor, and even though they don't get the taxes, they want income, they want a multiple. How do you do that? And if you're going to do oil and gas, this is the best way to do it, because this is a cash flow driven model, because we're drilling in where wells have already been drilled, and 80% of the cash flow goes out to the investors. So that's incredible. They love that. They love the cash flow. So we acquire, develop, and divest, ADD, which you don't need Adderall for that, but ADD, acquire, develop, and divest, is because we acquire properties in good areas, develop it, and then divest. Next slide is talking about the book and talking about why over 2 decades of experience. Jay's earned a reputation. I don't know. I've got about 4 decades of experience, not 2. But anyway, yeah, how can you start King 30 years and have 2 decades? That's a misprint. But anyway, I started. But anyway, I thought about oil and gas, so much, and thinking about what does the investor want? They want cash flow. They want a multiple. They want to be passive. They want to have a portion of their portfolio in oil and gas. That's great. Then why invest with me? What can I do to help them develop the best investment vehicle for them. And that is, okay, let's do some, let's think about this. And I spent a lot of time with a lot of rich people, fortunate to do that. And when I did, they were talking about how they did the value add. So if you'll look at my book on the back cover, David Moore with Night Vest was a multifamily guy. And he told me in 2015 about this, what he did. He'd buy an apartment complex that people were tired of, and he'd buy them and then fix them up and sell them or rent them out. And he talked about that model. And I'm like, wow, man, I can do that in oil and gas. And we did. And the next year it was 130% returns for our clients. And we're like, okay, we're on to something. So since then, we've done the same thing and just thought about how do we, so now we're raising bigger funds to go after bigger areas. So the next slide is also other people that we've added. I'm sorry. This is advantages of King. And I had a guy in the other day and he was talking to me and he said, well, tell me about your competition, your biggest competition, and tell me about, you. And I said, well, I've been through this so many years. Thoughts, is that they may offer the tax benefits for passive income, but they don't have monthly distributions. A lot of them have quarterly distributions. Number one, they don't have an exit strategy. They may tell you they have an exit strategy because, we're going to drill these and sell to Exxon, or no, they're not. There's no way they can. They can't, right? I mean, you don't drill 10 wells and after you drill the 10 wells, then send out monthly distributions, and then somebody wants to buy that. That's ridiculous. They can't do it. Diversification, target hold 3 to 5 years. You'll hold those assets forever because you can't sell them. So there's no market for them. So I should have said something like, okay, if you invest $100 million with them and you invest $100 million with me, what's the difference? Well, Joe, the biggest difference is ours is like a business to where we can drill wells inside the partnership. We can increase the value by drilling more in the future. And we do let out monthly distributions, passive income, exit strategy. It is diversification. Target hold 3 to 5 years. I mean, we're looking to increase the value over a short period of time and sell, 3 to 5 years, so you're catching me in a really good time in my career to where I'd love to either it be very passive income to where we're just sending out 20% a year checks when everybody already has all their money back, or we just sell the whole entire asset and move on. So,
okay. So let's walk through the structure. Your participant, I'm assuming is a 506, is a partnership. What's the structure? What are the minimums for participation? That sort of thing.
Okay. Yeah, it's a 506. Whichever one it is, that's the most open. Anybody can invest. See? Okay, good. Thanks, Tom.
Okay.
And so you have 506C, and the minimums are we don't do many 50,000s. There's some, mostly it's 100. We have 200,000 units, 200,000 positions, and we're raising. Well, it doesn't matter about that, but you don't know. We can't talk about the fund itself unless you call Tom or Cole Oliver, which
right.
But it's 50 to 100. We don't let a lot of 50,000s out, but if you have a situation where you could add to it in the future or something, and the reason why is because we have a lot of things we need to do, and we need capital to do that, and we want to make sure everybody's comfortable investing. So call Tom, call Cole, talk to them about what's about the investment. We're raising the money right now and we're putting the money in, but we're also drilling wells. Revenue starting to go out this month for our fund that we're doing. I can't talk about it specifically, but if I was going to talk about it specifically, revenue goes out soon, and we send out revenue on a monthly basis by the end of the month. And we're buying assets today, and we're not only buying assets, but we're also drilling inside there which is the best return on capital is drilling for oil and gas and hitting wells and being in a good area. So we're excited about that.
How do the investors stay on top of what you guys are up to? Do you issue a briefing or quarterly, or is there a letter from you that goes out? How do they stay in touch and keep an eye on what you guys are up to?
Yeah,
Here,
they'll
I
be
can-
working with Tom and Greg. I'm sorry. Go ahead. Go ahead, Tom.
Yeah, we send out not only a monthly newsletter. We kind of talk about what happened that month. During that monthly newsletter, we also, for each of our funds, we do a separate one. We tell everybody, hey, here's what your monthly revenue is this month. We talk about what happened that month, what's going to happen the next month. In addition to that, we have a weekly 2-minute, what we call the 2-minute drill, where Jay or a member of our staff here gets on and talks about what happened that week in a short little 2-minute video that is emailed to you once a week. And then every quarter, we kind of have a quarterly business review where all of our executive team gets together, talks about what happened during that quarter and what we have coming up for the next quarter. So you're very, very well informed at all times. And of course, you got whoever your senior vice president is here, you always have them at your disposal as well to answer any questions.
That's great. And is that possible for, a lot of our folks like to get, there's a saying that we make friends slowly, so we get to know you a little bit, and then we invest. And are non-investors able to sit in and watch that stuff too? So they just kind of get familiar with you, get more comfortable with you as time goes on?
Yeah, we have a regular newsletter that they can sign up for as well. It won't be specific to the fund, but they do have a way to do that. And just contact Cole or I through email, or give me a call, whatever, and we can get you on that list, no problem. And if you want a copy of Jay's book, just shoot an email to me as well.
Okay. All right. So there's been a couple of questions. Basically, Gary's asked us basically 100K minimum, possibly 50K in short term. ROI on month. Is there an ROI on monthly distributions? He's got a question mark after that. Gary, I hope I'm doing you justice here. If you do sell in 3 to 5, is there any added ROI or a certain multiple? He's asking that as a question. Is that?
Yeah, we can't really talk about that, can we, on this? But it's in our deck, right? Right, Tom?
Yeah, absolutely. Just like I said, just contact Cole or I, and we'll be glad to go through all of those questions with you. And those are very good questions. All of that information is in our slide deck that we can definitely get out to you.
Okay. And then John is asking, he seems to have a little bit of knowledge. And Gary says, understood, thanks. So you may hear from him. And John is writing, and he seems to have a little bit of knowledge about this business. He says, you compared your strategy to buying tired apartment buildings. Are you recompleting wells, drilling contiguous acreage? As questions, are they permitted before you acquire?
Yeah, good question.
Permitted.
I think it was 3 questions. So let me think about what. Are we reworking wells? We're refracking a well right now that didn't get a good frac on it several years ago, so we're redoing that. But the biggest upside is by leasing wells and getting and drilling wells. So that's our claim to fame, or that's what I love doing more than anything. And permitting is not a problem. We're doing it in Texas, Oklahoma. We're not in New Mexico. We're not in Colorado. I mean, we are with some things, but this fund will not be in those. Our assets are basically Oklahoma. I don't think there's anything in Kansas right now we've looked at, but it's mostly areas that we concentrate on. We can get a permit in a week, not a year. We just finished up a permit. Tom, that thing took us how long up in Colorado?
Is it still going on? No.
Yeah, I know.
Yeah, it took us a long time, time, 3+ years. Just to, and that's just to deepen a well. I mean,
Wow.
so We've exited the Colorado drilling area, although we are still doing some there, but
Yeah. It's just crazy in different areas. Wyoming was the same. We had an asset in Wyoming. We got out of it. We're in Texas. We're in Texas right now with all of our assets that we have in fund. In one of the funds that you can look at, I can't say anything specific, right? But,
Right. So
yeah.
this is where, so Gary has one other question. He says, am I
Mhm.
correct to say that you're setting up a fund where you drill wells in one area or multiple areas and states?
Yes.
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 Gary, what we do is we target, and it takes us, usually 10 to 12 months. We target very large acreage positions that have been drilled in vertically. And we go in using new technology, new horizontal drilling techniques, as well as new fracking techniques in those same areas that have been productive over years, uh, with vertical wells. And then along with that, we acquire 3D seismic if we don't already have it. There's a lot of different things that go into it, but yeah, and not only do we look for big acreage, we look for big acreage. We want, 3 or 4 different assets in each of our funds. Diversify and de-risk you right there. So yeah, but we can go over that all in the deck.
Okay.
I didn't say anything, Joe. I'm not supposed. I don't think I did.
Yeah. I don't think you did. I think you're good. So Gary, all right. Gary says he got it. So we'll
Yep.
be here from
Good
Gary.
deal.
John
Look forward to
wants
hearing
to
from you.
John wants to know what makes your well easier to divest.
What makes our what we are is a good question. That's a really good question. I know it's kind of hard to answer everything, but our goal, like on the 60,000 acre, if we did have a 60,000 acre ranch in one of our funds, I can't say specifics, right? So, but let's just say we did. Or let's not talk about that. Let's just say we develop up uh, 200 locations. Let's say that we find 200 locations and we go drill 30 or 40 of them. Well, what we do is we leave this behind. We drill up a certain amount of wells to prove up the area, prove up the acreage, because Exxon, XTO, these bigger public companies, they can't take any risk. They can't go, oh yeah, let's go out here and do it off vertical wells like we are. So we're not taking huge risks because we have vertical wells that have already produced. But so what we do is we find the vertical wells that have already produced and then go drill horizontal wells. But how do you divest it? The biggest way to divest an asset is to have, let's say you find 60, you lease the land for 60 locations and you drill 20 of them and you leave one horizontal well on each side that has not been drilled yet. So you have 20 wells that have been drilled. You have 40 locations that an oil and gas company can drill in the future. And they pretty much know when you drill a well, and let's say you get 1,000,000 barrels of oil, 1,000,000 barrels of oil, then you say, okay, there's 1,000,000 barrels of oil in this well that was drilled. And then you have 2 offsetting locations that each one of them can be classified as a 1,000,000 barrel producer. So therefore, and even the SEC allows you to classify that as a 1,000,000 barrel PUD. And then you sell that to the oil and gas company saying, hey, we drilled 20 wells. Here's the results. We've got $5-10 million in cash flow. And we also have 40 locations that you can drill in the future called PUDs. And that's very, very attractive for an oil and gas company. That's exactly what we're doing in the two areas so far, maybe a third area that we're doing in a fund if we had one, if we had a fund, right, Tom?
Yes, sir.
Yeah, okay.
And to tack on what Jay said, that and I'm going to go back to this slide right here. We talk about exit strategy. The biggest difference between us and everybody else out there is within our funds, you own everything. You own every well that we drill, and virtually, I would say 98% of what we drill is brand new grassroots wells that are horizontal wells. But the exit strategy, what I'm getting at here, is not only do you own every well in the package or your pro rata share of it, you own every lease that we have. And we're approaching, I think, Jay, right around 100,000 acres of leased acreage. That is where the big money is made. If we go out, we do our job right. That is where the big money is in the acreage. It's also there in your production, but there's big money to be had in the acreage, and that's why Jay wrote the book, the upside of oil and gas investing. It's truly all about the acreage and how much of it you have, because if you're in leases for $200 or $300 an acre, we go out, do a good job of drilling. Those leases go up in value, just like Jay was talking about, the PUD value, the proven undeveloped wells that go along with that. So I just wanted to kind of add that in there.
Thanks. That was pretty thorough. John wants to know, what are the largest risks? Cost overruns on drilling, or what else?
Well, if you drill enough wells, you're going to have some cost overruns on some wells, and two, we're drilling in areas that we're very familiar with, which is really great. I wouldn't really, I say I wouldn't worry about it. We do worry about it, but I don't think you need to worry about it. And you're not having cost overruns on wells that I can think of a lot more riskier places to go drill wells, in my opinion, where you could have a lot of cost overruns. I think the risk that I can see, and it's still not, I mean, it's still not 100% that it's a risk factor, but if you drill these wells at 55, 56, $57 a barrel, and oil goes to 20, $30 for a long period of time, that's gonna be some problems. I mean, you're not gonna get the returns that you wanted to, obviously. And I mean, I think that's the biggest commodity price, in my opinion, is the biggest risk. We're gonna drill a lot of wells. We're really good at drilling wells. We got some great people on our staff. I thought we had a slide on it. We took it out, but on our technical staff, that's just unlike any other. The guys have drilled thousands of wells and know how to drill wells. But we're drilling in areas that we already know, so it's not like we're drilling, wells that you may see offshore or something. So we're very familiar with the places we're drilling, and we get a lot of bids, and we have some really good people.
Okay, Gary wants to know what the potential is for capital call.
I don't want to say zero, because my lawyers and my wife would really get on to me. She works with me. My wife's here, but I don't say zero, but
You ever had to do one?
when's the last time we did a capital call, Tom?
Probably 5 years ago, a very small one compared to the size of the fund. And I'm just going to piggyback on that question. If that were to ever, if we were ever in that position, we would pivot and do a reserve-based loan against the production we already have that's non-recourse to the partner. So to answer that question,
Yeah,
we could call,
very unlikely.
call, but it's highly unlikely. Highly unlikely.
So, Gary, I hope that answered your question. As a complete, naif when it comes to this industry, I'll ask a question from a totally outside the box investor. You're looking at, it is a commodity, it is a global price. What if the Saudis turn on the spigot? What if, Russia and its needs for what it's doing over there turns on the spigot, and we go to something like we saw in the early 80s? Is that is that a totally doomsday scenario that's not likely to occur? Or that would be the thing I would think, anything that pushes the price below recovery.
Mm-hmm.
And do you see that happening at all?
I mean, I don't see it happening, and I'm not just saying that because we're in the oil business. I listen to a lot. I read a lot. I'm asking a lot of questions on all media sources, so therefore it's important to know facts. about what's going on, being realistic and what could happen. Why do we see this happening? Why would it not happen? I just don't see oil prices, the doom and gloom days, of $20 barrel oil, because we don't have the supply and demand's just it's just there. Demand's there. Demand, around the world is there. And there's a lot of countries that, they let's there's thousands of companies in the United States that develop that 13 million barrels a day, or drill and produce wells. And in these foreign countries, if they sell 300 million barrels of oil a year, that's their budget. So if they sell 300, a billion, whatever they sell, let's say Saudi Arabia sells 1 billion barrels of oil a year, well, they much rather sell it for $30, $20, or $100. Well, the obvious is $100, because that's how they make their money. That's their budget. That's how that's their top line revenue. And that's why I don't see it happening for very long. If it ever goes to 20, because I don't think it'll go down that far. So I think we're in a good, I think we're in a good area. If we're at 50 to $60, there's going to be companies out there that are going to love what we do in our fund. And we're not a shell driller. We're not in the Permian Basin drilling Permian Basin wells that you need $60, $70, $50. We don't need that. We're in different areas that have different economics.
Okay.
And
right, thank you. Yeah, that answers
I'll
it.
pile on there, Joe. Cole always has a good answer to that question. And Jay is exactly right, but the only other thing would be like a COVID 2.0 or something like that. Or
okay,
something weird.
Something real weird. A black swan. All right.
If that happens, we're going to have more problems in the world than just
yeah.
Be a lot
somebody's $200,000 or whatever,
That's
or
right.
$9 million, $2 million worth of. Yeah.
Be worried about more than our portfolio. So
Yeah. Especially,
Well, Gary's given us a thanks for the answers to the questions, and I think we're hitting close to the top of the hour. So, I'd like to thank both of you for coming on. This is a huge value add for our people. It's enlightening. I learned a lot. Jay, it's a pleasure meeting you, and thanks for all that you contributed here for our listeners and our viewers. And Tom, it's great to see you again. I hope our paths cross at some point in time. And,
they will.
Yeah. And so, and thanks everybody who registered and who sat in. And for those of you who are watching this on the replay, thanks for watching it on the replay. So this is Joe Fulvio. This is Camaplan's weekly webinar, and we've been talking about the oil and gas business. So take care, everyone. And I'm going to stop the recording and
Thanks, Joe.
sign off. Thank you so much, both of you. Really appreciate it.
absolutely.
I'll be in
Thank you,
touch.
man.
Okay. Thank you. Bye-bye.